Yeah, good morning to one and all. I welcome you all to this the series of the Valuation Manthan. Today we are going through the series 4 and the corporate transaction, the business valuation is the topic of the day. We have a very learned and the star speaker of the program, CA Chandar Sani ji. We have been joined by our vice chairperson of the committee, also the board, also Preeti Savla. She is here. She has just joined. The moderator of the program is Inderjit Kaur, and well supported by the secretariat of the committee, headed by Sonali Das Haldar. She is the secretary to the board. And naturally, you see, like the objective and the purpose for which this series has been started with is going strong day by day, starting from the opportunities available and going forward many valuation mechanism and for the different sectors in the different areas. And naturally, you see like the valuation is a area which needs everyone needs at a different point of time, understanding during the audit system also, Ind AS and the IFRS also, and the going forward for the business merger acquisition and many things on the way. You see, like this board as such is taking care of many standards which has already been framed, which is mandatory to be followed by the chartered accountants fraternity. And going forward, we have many things in our mind which will be taken care of, not limiting to the financial as far as the valuation, but going forward for the land and building and the other aspects, also plant and machinery also, so that holistically we can showcase to the government also we are a complete understanding and we have a complete structurally in the system to be taken care of. So with this initial remarks, I welcome you once again, all the our participants, which are huge in numbers. Every time we find a greater heights are being achieved every Sunday, we are getting better and better numbers running into the thousands, and today also we the numbers are quite high. So that shows the power, that shows the you see the way the mindset or the way this program is being started with. Today we are fourth in the series, and going forward many more will coming into running into for the whole of the year. And naturally, you see like well supported and well hold the team at a different level. Now I'll request the vice chairperson of this board, Preeti Savla, for her initial remarks for the participants. Preeti, over to you.
Thank you, Ansaraj Bhai, Chairman of Valuation Standard Board, and I can also say the doing FRRB good work and lot of things. Ansaraj Bhai is contributing to the institute for the betterment of institute and members, students, and the government and the stakeholders at large. So compliments to Hansraj Chubji. Friends, good morning to all of you and welcome to the fourth series of Valuation Manthan. And it is our endeavor to serve the best in various ways, contributing and coordinating with the regulators and also building the capacity of members by organizing this kind of webinars. And it is nice to meet all of you on every Sunday morning after having the breakfast. And today we have for series 4, Mr. Chandar Sane will be taking through us the journey, the valuation, the topic, and Inderjit will be moderating the session. With this brief, I once again welcome all of you and wish you a happy learning. I have received, and even Hansraj Chukji has also received various messages from the valuation experts. Okay, we also want to contribute. When we were starting the series, we were wondering how we will do, how many speakers will take up, and whether we will be able to have the speakers. But now we are, in fact, rather receiving the messages and the calls from the various experts. Okay, we also want to be the speaker and share the knowledge, and this is how it is how the this series has evolved, and we'll serve the best and ensure that best of the speakers are coming sharing the practical experience and the knowledge. With these words, I welcome all of you and wish you a very, very happy learning. Over to Inderji.
Inderjit, now you have to introduce the speaker and the way forward speaker will take over. Your voice
You
is
are
not
not
there.
audible. Huh?
You are not audible. Inderjit, you are not audible. I think some technical issue or something.
You can exit and once again join. Otherwise, if required, if it is not. So today we also have the sustainability social audit exam training course and sustainability outreach program. Lot of things are simultaneous. By the time she joining, I thought okay, I just share with all of
Right.
you.
You may say.
So I'll be taking the leave for that.
So you are doing a great job, sir. This is actually the requirement of the industry of how to build capacity because valuation is an evolving field. And we are every day seeing that even regulator is looking into valuation from a different perspective. In fact, framing of valuation standards, even disciplinary actions, and a lot of things are going on in valuation community.
Inderjit,
Yes, sir. Am I
now,
audible?
yeah, now you are audible. Now you can introduce our learned speaker. Then
Okay,
he will be starting the session. Yeah.
okay, sir. So thank you, everyone. Thank you, C.A. Hansraj sir and C.A. Preeti Parasavya ma'am for introducing the uh, importance and why we all are here for the Valuation Manthan Session 4, where we all the speaker will covering the types of corporate transaction and business valuation requirement. So, as our esteemed dignitaries have shed light on the topic at hand, so it is now our privilege to introduce the speaker for today, who will share his valuable insights on the matter. That's C.A. Chandra Sahani. So, let's welcome sir with a brief introduction. So, C.A. Chandra Sahani, who is the founding partner and head of valuation and deals at Transit Corporate Advisors, which is a professional advisory firm strategically focused on valuations, transaction advisory, corporate finance and deals, and tax, legal, and regulatory services. He is also a fellow member of ICI, ICSI, and also a registered valuer of IBBI. He has over 18 years experience of business valuation, transaction advisory, and deals, having performed 2000 plus valuations and 200 plus transactions across 30 industries. Mr. Sahani has served at prestigious positions as a member of central government committee under companies registered valuers and valuation rules 2017 and entrusted with the responsibility to recommend the Indian valuation standards. He also acted as the lead author of 2 editions of valuation book titled as Business Valuation in India Beyond the Numbers. And he has addressed several valuation and M&A conferences and seminars organized by leading industries and professional bodies. Mr. Sahani has gained significant international exposure while dealing with clients and professionals across the globe in connection with their valuation and transaction matters. So please join us to welcome CA Chandra Sahani sir. Please sir take the session forward.
Yeah. Thank you, Inderjeet. And thank you, Ansraj sir, for inviting me for this session. And I'll just share my screen so you can confirm that it is there.
Yes sir, it is visible.
Yeah. So basically, if I just give you my broad background, see, I have been doing valuations for the last 18 years now. And I have seen the full ecosystem of valuation evolving in India since the year, I would say, 2000. So I started my career in 2005. And since then, I would be taking you through not only the types of corporate transactions and valuation requirement, because I have seen the past three webinar Manthan programs which have been conducted. And so I have adjusted the presentation accordingly. And the objective is very simple, that everybody should take home something. We are investing on time on Sunday, so it should not go waste. And we should actually get enriched with some knowledge about valuation, some knowledge about the regulatory ecosystem, and how this total valuation model is working on in India. So I'm just starting, and the broad agenda is broken down into three parts. One is the overview of valuation, focused on business valuation, which we also called as equity valuation, brand valuation, intangible valuations. Essentially, we can also say securities and financial asset class valuation. Moving to the second part would be the type of corporate transaction and valuation requirements. And the third would be an interaction round. So Inderjeet, any questions that come, maybe we can take it at the end of the session. If you want to ask, you can ask in the middle of the session also. There is no problem. But the idea is not only to look at regulations, the idea is also to look at how the valuation ecosystem has evolved, where do we stand, and at this crucial critical juncture, a lot of questions are there in the valuation community. So I have created a few questions myself, and happy to take up more questions from the respected audiences. And I'm sure, there would be a lot of chartered accountants, valuation professionals, even corporates. So let's proceed. See, I'll just start that price is what you pay and value is what you get. And this is a master statement by Mr. Warren Buffett. And it's just mentions that, when we buy something, when we sell something, let us say on a stock exchange or in a market, then there is a fixed price to it. You cannot change the price. That is what it is. And that is dependent on the demand, supply, and a lot of other things as well. But whether it is worth the same value, whether the value is same, value is different, less, more, that is the objective here. Valuation is very different from price, is what I want to mention here. And our objective is on deriving the fundamental valuation. Price will vary. Sometimes it may match, sometimes it will not match. Let us go through the history of business valuation in India. Because what is happening that if we just jump on valuation and don't understand the background, then it will not be correct. So the valuation in India is happening since the days of 1957, which is the Wealth Tax Act, which is actually repealed now. But in 1957, there was a methodology which was under Wealth Tax, essentially a breakup value methodology or an asset-based approach. And essentially, we used to compute some kind of, adjusted book value method. And that was the valuation methodology for valuation of shares. We moved in 1990. So from 57 till 90, this was the only mechanism. In 1990, Comptroller of Capital Issues Guidelines, which are also called as CCI guidelines, came into play. And CCI guidelines was also a formula-driven valuation. So there was an asset valuation, there was an income valuation, but that was a historical income valuation. It was not a futuristic or discounted cash flow valuation. The methodology used to be called as price earning capacity value, PECV method. So PECV method used to take an average of last 3-year profitability, and it used to capitalize that. And in fact, the capitalization rate were also prescribed in the regulations only. So whether if there are, let's say, 50 people doing valuations, almost all of them will come out with the same valuation number because it was a formula driven valuation. In 1992, when SEBI came, then SEBI came out with a free pricing mechanism. So if we look into the IPO valuation and IPO pricing today, there is no requirement of valuation in IPO. IPO is freely priced by the company in consultation with the merchant banker. And if there is a demand, it sells through. If there is not enough demand, it does not sell through. We have seen a number of IPOs which have been, which were overvalued. And we know that, they are trading at a significant discount today. And there are a lot of IPOs which were, properly valued. And so there is a appreciation on that. So the message here is that since 1992, we entered into the free pricing mechanism. I am sure this slide would actually help the valuation standard board of ICAI also, because actually ICAI had for the first time issued a guide on share valuation in 1994. If you go back, the institute has been working on valuation since the days of 1994. And there is another guide which came in 1999. So there is focus of the institute to give guidance on equity valuation, business valuation matters. But what happened actually, if you look forward, then since 2008, 2007 and 2008, all the regulations on valuation started coming. So SEBI for the first time brought the requirement of fairness opinion in 2008. Income tax brought the valuation for transfer of shares in 2009. There used to be fringe benefit tax on employee stock options in 2007. Which later got changed to the perquisite tax in 2009. Discounted cash flow valuation, which we so use every day, was actually prescribed for the first time in Indian regulations under FDI guidelines in 2010. So if you look into all this, I mean, it has been a journey. And then, income tax prescribed issue of valuation for issue of shares in 2012. In 2016, a big change took place, which was acceptance and adaptability of Indian accounting standards. So Indian accounting standards came into force in 2016, and all the accounting shifted from historical cost to fair value. And this is a big change. These all things actually are the foundation of valuation, and these all things are important, that how the things have evolved. Another major thing that happened was in 2016 by way of insolvency and bankruptcy code. And insolvency and bankruptcy code again brought the concept of fair value and liquidation value of the assets of the corporate debtor. So here it's not a business valuation, it is an asset valuation. And against that asset, then it is decided that how much amount is to be paid to the creditors or the financial institutions. Then the registered valuer provisions came in 2017. ICAI again brought valuation standards in 2018. Then there was a central government appointed committee, of which I was also a member. And the role of the committee was that how to frame the Indian valuation standards. And that led to actually the institutionalization of valuation and submission of a draft valuer bill also. So as on date, the draft valuer bill is pending with the Ministry of Corporate Affairs. And all that we are seeing, the RVOs, these training sessions, these are all originating from companies, registered valuers and valuation rules. The valuation standards, again, the ministry, the rules have given an option that each RVO can frame their own valuation standards until and unless the central government comes out with Indian valuation standards. So as on date, there are no Indian valuation standards. The central government may come out with it. Till that time, there is an option for RVOs. So some RVOs have adopted the international valuation standard like IVSC, and some RVOs like ICAI RVO have created their own valuation standards. Largely, if you look into the valuation standards, then valuation standards are principle-based standards. They do not teach us how to apply valuation in real life. So the valuation standards, whether ICAI valuation standards or IVSC valuation standards, you will find compatibility to the tune of 95-98%. There is small deviations which are there, but the focus there is that it is very important for all of us who wants to build our career in valuation domain, and also who want to gain expertise, that there's a need for peer-to-peer learning also. So it's not that if I am doing valuations, then I know it all. No, I mean, every day we learn valuation, because when we are doing valuation, we have to keep our mind open. We need to understand the industry. We need to understand the market. We need to understand the company. We need to understand finance, tax, laws. It is a holistic subject. And, at the end of the day, whatever we learn, there will always be value or opinion that will be very important, and value or experience, which will differentiate actually a good valuation and maybe a not so good valuation. And I also take up later on the challenges that our community is facing with respect to some, disciplinary actions which are being taken. But then again, we have to be aware of the fact that as a valuation professional, we need to be, aware of all the requirements of valuation. So let's take it step by step and see that what all things can be done in valuation. See, principally, before we dive into the methodologies on valuation and all that, we should understand four guiding principles of valuation. What happens that sometimes we say that there is a profit making company, it is not performing, or there is a loss making company, why is it getting so much of valuation? There are always too many questions which are there in maybe corporate mindset, maybe valuers mindset. If we keep our basics strong, then I think a lot of questions can be addressed. It's not necessary that we need to be an Excel professional or a very strong Excel professional to take care or deliver a strong valuation report. Sometimes we forget the basic principles on valuation, because of which most of the valuation mistakes happen. And let me tell you, the regulators don't understand the finer aspects of valuation in terms of the technicalities of valuation. So if a valuation story is good, if the justification is good, assumptions are made, disclosures are given, documentation is there, in my view, that's a good valuation. So the first principle is that the return on capital employed should be more than the cost of capital. Sometimes we have a cost of 10 and the return is actually 8. So return cannot be less than the cost. The moment return is less than the cost, there's a fundamental problem with the company, and you have to look into that, because at a point of time, it can be having a high value, but fundamentally, if the return on capital employed is not more than the weighted average cost of capital, then the valuation, it could actually be in a question mark. Second is conservation of value. Conservation of value means that sometimes, there are a lot of accounting adjustments which are done. And remember that sometimes if a company is not able to make profit, it will do a lot of financial jugglery. We have seen in news, statements wherein accounting recognition has not been done correctly. Bejus, we all have known of that, that for example, if there is a 100 rupees of revenue from a particular stream, but that is actually due over a period of 24 months, right? But can we do that accounting, whole 100 rupees accounting in one financial year? Ruling is actually an IRS revenue ruling, and the revenue ruling number is 5960. The meaning of 5960 is actually it's the year. It came in 1959, one of the oldest ruling on valuation in India. What does it say? That there are 8 principles when you do valuation. You should see the business and the history. You should see the economic outlook and again, which industry it is operating. You should look into the book value. Book value, let's say it's an asset approach. You should look into the earning capacity value. Let's say it's an income approach. You should again look into the dividend paying capacity, which is again, dividend. If you pay dividend, you add value to your shareholders. You should see intangible value, which is again very, very important because most of the companies are service oriented now. You should look into that, what is the size of the stock and what is the sales of the stock. Basically, what it is telling us that you should look whether it's a minority value or it's a control value, and you should look into market price of stock of similar companies. That means we should do comparable companies market multiple method. Now, very interesting. This came in 1959, and all of these 8 principles are actually what we are doing in practical life. So idea is to know and move, right? I also strongly believe that business valuation is beyond the numbers. Most of the time, the focus is into Excel sheet, dragging into, but it doesn't help in my view. As a professional, even as a corporate, we must have the strong understanding of valuation principles. We must know the valuation requirements under different laws. We should have a fair understanding of the industry dynamics. What are the valuation multiple? It's not that a pharma and a healthcare company, it's not that a hospitality company and a sugar company or a steel company gets same multiples. No, some companies get valued on a price to book value basis, like for example, the banks and NBFCs, but most companies are actually valued on an EV/EBITDA multiple, which is the operating cash flow multiple of that particular industry. And each of the industry multiple actually changes at each point of time. So don't think that a valuation which is done today and 3 months back, the multiples will be same. No, it will not be. Sometimes the multiples also needs to be adjusted. For example, if the valuation date is 31st March 2020, what would you do? I mean, it was a COVID year, everybody knows. The market was 40% down. So we cannot take a particular day. We have to take a historical average, maybe a 3 months average, or maybe a different average, which is appropriate. So it is all important that, including accounting standards. I just mentioned Ind AS 113, and I will take you through the applicable Ind AS also, which you should look into and which actually are required to be applied for different valuations. So Ind AS is there, and again, last is corporate tax. For example, if there are accumulated losses, there have to be the tax shield available, correct? If there are like an asset is being sold, you cannot just, or if an asset has a higher value, you can't just take a higher value. You have to take into impact the notional tax, which will also go. So principally, if you look into, we as chartered accountants are best equipped to understand valuation, taxation, accounting, industry. And that is why, holistically, if we look into, it's a very, very interesting proposition. Broadly, why do we require valuation? So I think, Inderjit, if you feel you have any questions you are getting, just to make it interactive, maybe we can take a few questions when you feel like. I am proceeding in the meantime, right?
Okay, sir.
Yeah. So when we say why valuation, see, broadly, we need valuation for three purposes. Either it has to be a transaction purpose. There is actual transaction. Something is getting bought, something is getting sold. It could be a business, it could be an asset, right? Second could be a regulatory purpose. Nothing is happening. For example, a company has had invested, or for example, some issue of shares are taking place, right? Now issue of shares are taking place, transfer of shares are taking place, transfer of business is taking place. These are all different corporate transactions, right? Which we will take in the second part of the session. And all of these require valuations. We must know that what are the applicable valuation requirements for each of the particular transaction. Third scenario is financial reporting. Nothing is happening. Transaction has already taken place. A company has made investment in another company. Valuation is required for impairment purpose. A company has issued employee stock options. Valuation is required for the determination of compensation cost. Correct? A company has acquired another company. Valuation is required for purchase price allocation, of how do we allocate the transaction price in the books of accounts of the acquirer. So broadly, three types of valuation which we need to take into account. Let's start with the first type, which is the financial reporting valuation and Ind AS valuation. See, everybody who wants to practice in valuation, and I'm sure my fellow colleagues would also be knowing, the Ind AS 113 is the only Indian standard on valuation. It is an accounting standard, but at the same time, it is a valuation standard also, because it is a fair value accounting. What it says is that fair value is basically to be determined on the measurement date. What does this mean? For example, there is a valuation date of 31st of March 2023. Now, when we are doing a valuation, we have to go back on that date and think that what was known and knowable. And all those factors which were known and knowable, my financials, my projections, should take into account all those aspects. Most of the time, sometimes we take subsequent events, sometimes there could be a different thing, but the principle is very clear that known or knowable on the measurement date, and measurement date is as good as valuation date. Another important takeaway from Ind AS 113 is that it gives emphasis on the observable inputs. So it says that what is an observable input? Observable input is something which is readily known. A share is traded on stock exchange and it is frequently traded. The market price is known. It is observable. A company is doing business today. Again, it is a bank-to-bank specific aspect, but in a larger view, banks are preferring to take valuation of registered valuer. Registered valuers have to follow the registered value regulations. So if you have to value a property, standalone property, I think the best is, that what is a comparable value of a similar property, correct? And that is the basis of that, in my view.
Okay, thank you. So another question, that if there is two wholly owned subsidiary private company, they both are into loss making and they want to merge. Both have negative net worth. Can the share exchange ratio be 1:1 based on negative NAV? Please guide.
So what happens here is that if these are negative net worth companies, first of all, we should look into that whether these companies are holding any investments or any fixed assets. Sometimes, so negative net worth is book value, but what is the fair value? They may be holding an investment, they may be having a real estate. So if there is a real estate, do fair value of that real estate, at least take the circle rate for meeting the regulatory guidelines. And if there is investments, do value the other investments. And if considering that even after taking everything, the value remains negative, then maybe you can take a fair value of whatever is the face value of that company. You can take that face value, because one company may be having a 1 rupee face value, another company may be having a 10 rupee face value. So doing 1:1 may not be right. But if the face value is both of these companies are 10 rupees, then I think you can take 1:1 in that case. But again, the number of shares would also be different, right? So the ratio will be a subset of what is the value and what are the number of shares. But yes, the value per share should not be less than the face value. That is what my view is.
Thank you so much, sir, for answering this question. We have another question. Please advise regarding most suitable method of valuation of shares of unlisted new company owning only land with reference to section 50 CA and 56 subsection 2 subclause of 2 of Income Tax Act.
Yeah, so I think it is very simple that you have to prepare an audited balance sheet on the date of the transfer of shares, which is the requirement under Rule 11 UA and Section 56 to 10 and Section 50 CA. And you have to take the circle rate of the land. So the regulation is that whatever is the circle rate of the land, that has to be substituted with the book value of the land. And that is the only methodology you need to follow for this case. And this will be the minimum price. Remember that under different regulations, some regulations prescribe minimum price, some regulations prescribe maximum price. So it's a challenge. So when we say transfer of share, it's a minimum price. So any price which is above that will work.
Thank you, sir. We have one last question.
Yeah.
With that, will draft Valuer Bill 2020 subsumed other standards, and the same will be applied to different scenarios like in income tax, ESOP, business valuations, etc.?
Actually, the background of the draft Valuer Bill is that right now there is no valuer regulator. So as a chartered accountant, we are being governed by ICI RVO. As a company secretary, they are being governed by ICSI RVO, and there are multiple RVOs. The idea is that we as chartered accountants are governed by the Institute of Chartered Accountants of India. But there is no separate regulator of the valuer. So the end objective is that there should be a regulator, independent regulator, who should act independently. And then, that ultimately this IBBI is also not, IBBI came for insolvency cases. It never came for valuation cases. But when there was discrepancies in valuations, then IBBI was given additional powers of valuation also. So ultimately, when the valuer bill enacts and there is an independent valuer, then the moment everything will move to that independent regulator, and then the regulator can look into the things holistically. Right now, if you see, then these registered valuer regulations are broadly applicable to Companies Act and IBBI, Insolvency and Bankruptcy Code. But there are many other valuations also, right? So I'll take it up as we proceed. Yeah, so thank you, Indrajit. So I'm just proceeding. It helped actually to make it a little interactive. So let's look into the registered valuer, which a few questions also came. See, let's understand that now registered valuer is there since 2017. And besides the Companies Act and IBC also, there are few other regulators who have voluntarily adopted the registered valuer regulations. Like SEBI ICDR regulations, if you look into, then for a preferential allotment, you require valuation. For even a merger, you require valuation, which has to be done by a registered valuer. Sorry. For SEBI REIT and InvIT regulations, again you require a registered valuer. Recently, RBI for the ODI restructuring cases have also permitted registered valuer to do. And the AIF portfolio investments, very recently the SEBI had came out with that who should value the AIF portfolio. And in the basically consultative paper, the mention was of registered valuers. In the final regulations, they have not prescribed who will value, but in my view, we can expect AIF portfolio investments to be shortly done by registered valuer. What has changed? That there has to be, every registered valuer has to follow valuation standards. We have seen a lot of disciplinary actions against a number of valuers for not following valuation standards, for not following the format of the report prescribed under the registered valuer regulations, for not following the model code of conduct, for not disclosing adequately. So please make sure that whatever is written in the registered valuer regulations have to be religiously followed. I mean, you cannot say that the no management representation letter will help, no clarification of management will help, because let me tell you, just read the items which are mentioned on the red side. The assessing reasonableness of information is the responsibility of the valuer. Obtaining sufficient evidence to support the valuation is the responsibility of the valuer. Visiting site is the responsibility of the valuer. Most of the times, ask yourself whether we are professionally competent in the field of valuation we are doing, whether we are taking due care, whether we are independent. Most of the times what happens that there are professional pressures also, and time is a limitation. Sometimes we might have taken an engagement at a lower cost also. But remember that if it's a valuation which is being done for a regulator, then regulator expects us as an extended arm to them. So it requires skill set, it requires capacity building. I mentioned before, it requires peer learning. So we should all learn from each other. We should take the most of these webinar sessions and all, because as of now, the biggest challenge that our community is facing is this disciplinary proceedings. And most of the time, probably the regulators' expectations are also, I would say, too much. That yes, the valuer should do everything. There are practical problems, but must disclose everything in the report, because in the orders, if you would have read, if the valuer has disclosed, if the valuer has accepted, then there is a leniency which is shown by the regulators. But if the valuer has said that I was not aware of this, then there are many valuers who I know personally that their registrations have been cancelled for 6 months. So it's a significant and very important thing that we have to look into. And that is why probably I'm emphasizing on these points, because these points are the finer points which get missed out. What should be a typical valuation process? Let's look into that. First of all, do understand the purpose of valuation. Client will come to you, I want a valuation, please do it. Everything is okay. Without understanding purpose, you cannot do. I'll take up the purpose, that whether the purpose is financial reporting, whether the purpose is regulatory purpose, whether the purpose is transaction purpose. Basis that, ask the information from the company, normalize the financials. There could be financials. For example, we might be applying a relative valuation method. And in relative valuation method, let's say that we are taking PE multiple. And in PE multiple, we require profit after tax. Let us say that in that profit after tax, there has been an unreasonable and exceptional gain of say 50%. Now, when we take PAT, do we look into that what are the extraordinary items that need adjustments? If we don't adjust those items, value will be very different. Because if you look into the formula, then formula is profit after tax divided by the whatever multiple you want to give. And multiple is a different question itself, that how should the multiple come into play. So we need to do the adjustments of financials. We need to understand the industry. Once we have seen our company, we have seen the historical trends, we can build upon, we can actually review the projections. And I will take up the projections matter later on. But yes, if we have done the normalization adjustments, then we understand that this is a sustainable profit. These are the sustainable cash flows based on the observable input, like we just discussed. Understanding industry characteristic, each industry is different, each point of time is different. Sometimes few industries flourish, sometimes few other industries flourish. So understand that at this point of time, what is happening. For example, this time we are all talking of make in India, manufacturing. Right now, India still has a lot of service industry, right? But why manufacturing is not increasing? And if it does not increase, then how will our large population and large working population get accommodated? Because manufacturing requires a number of people, right? Even lower class people, and that is required in a country like India. So basis those things, understanding the company and industry, we can forecast and we can review the company performance, right? Basis then we have to apply valuation methodology, and at the end of it, we have to do the documentation. Coming back to the purpose, like I mentioned, transaction, regulatory and financial reporting is one. What is the premise of valuation? Whether the premise of valuation is going concern or premise of valuation is liquidation. If the premise of valuation is going concern, then we don't give much importance to the assets, because my assets are not being liquidated. But if the premise is liquidation, then we don't give much preference or much focus to the cash flows of the company or profitability of the company. So very important aspects are there. If you have to do a trading in a stock market, probably all that is important is short term. What happened today? What will happen tomorrow? But if the idea is to build a strong portfolio, long-term horizon, what are the fundamentals are important? Again, whether we are doing a minority valuation or a controlling valuation, a 2% stake may be valued very different. A 51% stake might be valued very different. And again, we should know that what is the difference between enterprise value and equity value. So the enterprise value is the value for the entire firm, and equity value is the value for the equity shareholders. So all of these items are important. We mentioned about income approach, asset approach, market approach. Practically for a going concern basis, all these green ticks are what we apply, which includes discounted cash flow methodology, comparable companies market multiple methodology, comparable companies transaction valuation, and for listed companies market price. So for a going concern basis, 95% of the time we would be requiring. So as a valuation practitioner, if we know how to do comparable companies trading multiples, comparable companies transaction multiples, and discounted cash flow, I think it makes our life quite easier. touching upon few basics of DCF and then relative valuation, followed by the regulatory section. So typically, if you build your cash flows, then this is how it looks like. That maybe, let's say, we have projected for a 5-year period, and after 5 years, we don't know, I mean, what will happen. So but the business will still continue. So after 5 years, there is a perpetuity period, and that perpetuity period is not forecasted. So basis the last year cash flows, the year 5 cash flows, we capitalize the same, and there are formulas for doing so. And let me tell you that this capitalization is quite sensitive. Even by changing your capitalization rate, your perpetuity growth rate by 0.5%, I mean, the valuation can be significant, because this perpetuity value is actually constituting the most, maybe 60 to 70% of the total value in a normal company. There is guidance in Ind AS 113, I thought I should just mention, but broadly for a DCF, what is important is that you have to estimate the cash flows, and you have to estimate the discount rate, and it has to be built on a certainty. The discount rate has to be market driven, industry wise, and there are formulas for that. I'm not going into that, but the idea of this slide is to know that there is a guidance in Ind AS 113. It is very simple. See, I can be having some views, you can be having some views, but whether those views are supported, whether there is a justification, you are doing a valuation, are you giving a supporting evidence? Are you giving that I have relied on this credible document? The moment you rely on that document, you follow that. For example, it's written that discount rate should reflect the assumptions consistent with those inherent in cash flows. What does this mean? That if the cash flows are going high, if it's a jockey stick cash flows, then the discount rate also have to be high. If it's a very conservative cash flows, discount rate have to be reasonable. Again, last point, discount rate should be consistent with the underlying economic factors. So the currency should match. I am valuing a US company. Can I take the Indian market discount rate? No. My cash flow currency and my discount rate currency should match. See, very, very basic principles, nothing to do with Excel, but most of the times, and I have seen that in my career, that there are, issues knowing it. So that is what I'm trying to just clarify. And again, some more guidance that it should reasonably capture the growth prospect. If the business is expanding, you should include. And I think we have covered most of these aspects. So I'm moving on. This is how a DCF model looks like, that we have to obtain at the net free cash flow of the firm, considering after meeting the working capital requirement, after meeting the capital investment requirements, what is the free cash flow which is available to us. And that free cash flow is on the basis of which the valuation is to be done. We arrive at an enterprise value, we adjust for debt and cash, we arrive at an equity value. Touching a few basics on relative valuation. What is the difference in a trading multiple and transaction multiple? I touched this, right? Trading multiple is taking the valuation from the market comparables, from the listed companies comparable. So if a company is traded in the market and we have to value an unlisted company, we benchmark the value of unlisted company with the listed company. That is a comparable trading multiple. It could be a P multiple, it could be an EV/EBITDA multiple, it could be a price to book value multiple. What is a comparable transaction multiple? Very same. The only difference is that we are not benchmarking vis-a-vis the listed peer companies, but we are benchmarking from the unlisted companies in which some corporate investments, private equity, venture capital funding has come. So one is a trading multiple, another is a transaction multiple. In one, there is a minority element. In another, there is a controlling element. So please understand that if you have to do a controlling valuation, you have to take a controlling multiple. If you have to take a minority valuation, you have to take a minority multiple. How do you finalize the peer companies? Most difficult. I mean, you can say that we want a particular value, we can take the company which is giving that kind of multiple. It doesn't work. You have to follow a process. Every time, if you follow a process of valuation, I think that is what is the expectation of the regulator. So please make sure whether using a BSc software, BSc database, or Capital Line or Capital IQ, whatever ACE equity, do take the entire industry. And here it is very important that even the industries are different in different softwares. So we also use one thing, which is the NIC code. So each company's annual return includes this NIC code. Do look into this NIC code, do benchmark through NIC code, BSc, and the software which you are using. There is a screener website also which is available. There is Damodaran database which is freely available. Look into what kind of multiple Damodaran is giving, what BSc is giving, what NSC is giving, what other softwares are doing. So doing so, all of those, we have to look into that. Probably what should we do? If we do a median multiple or we do a mean multiple. So median multiple is actually preferred because when we do a median multiple, then it eliminates the outlier. But if we take an average, because median is the mid number, correct? So idea is to take complete set of peer companies in the industry and not pick and choose. Remove the companies which are infrequently traded, because if there is not much trading and you take that, it is as good as an unlisted company. If my company is a small cap, for example, my company is having a 50 crore turnover, subject company, and a normal IT company, and can I compare it with TCS or Infosys? The answer is no. So do make sure that the size is very important. The profitability margins are very important. The debt equity ratios are very important. And this is the most challenging part. And most of the valuations in comparable companies will change the moment. So the role of a valuer, the role of a company, the role of a regulator is actually, even for transfer pricing, right? Even for transfer pricing, we know that we have been preparing transfer pricing reports. And the idea is that we should follow a process which is a complete process. How do we adjust for non-operating assets? I mean, when we say that we have to apply an EV/EBITDA multiple, suppose there is a new plant which is under construction. What will you do? Whether that new plant is EBITDA is coming from that new plant? Answer is no. If not, then what should you do? So those needs to be separately added. And a lesson here is that we should segregate the operating cash flows. And similarly, we should segregate the operating business and non-operating business, operating assets and non-operating assets. Operating needs to be valued on the basis of valuation formulas, and non-operating needs to be valued separately, whether it is a surplus land which is not leading to cash flows, whether it is a capital work in progress, whether these are any kind of vacant land or maybe investments. I have taken my standalone cash flows. I have taken my standalone EBITDA, but the company has made investments. So how do we value these investments? We value these investments independently at fair market value. So all those things are important. We need one session each for each of these, but and like we discussed that these are the pros and cons of different multiples: PE multiple, EV/EBITDA multiple, EV by sales, and book value. All these e-commerce companies, all these online startups not having any profits, you cannot apply PE, you cannot apply EV/EBITDA, you cannot apply the book value multiple. The only multiple which is left is the EV by sales multiple for them. The most important and the most preferred multiple is the EV/EBITDA multiple, because EBITDA is as good as cash flows. And like we discussed, that nothing is more important than a net cash flows. Whatever you do, PE multiple could be, though it is used in market, but PE multiple is prone to accounting adjustments. So that is why, probably EV/EBITDA takes care of those part. We have already discussed that, it is a valuer's responsibility to choose the appropriate method, and valuer should use the observable market information. But in general, for a going concern basis, we have to value using the income approach and the market approach. For liquidation case, we have to value using the assets largely. There are few categories, like few methods result in minority value, few methods result in controlling value, So we need to adjust that. We have to understand. For example, if you have to value for an employee stock option plan, now employee stock option plan, can it be valued using controlling value? Should a DCF be applied for that? Should a comparable transaction multiple be applied for that? Maybe the answer is no. What should be the methodology? The methodology should be those result in minority method. And the most appropriate method is comparable companies trading multiple method, which is CCM method. If you have to value acquire a company, you have to invest in a company, you have to do a joint venture in a company, most appropriate method is comparable transaction multiple method or discounted cash flow method. And probably one finer adjustment is that we should map the base and levels of value with the valuation methodologies. So we might have used a controlling method, right? But the requirement of valuation was to derive a minority valuation. So there is a requirement of adjustment of discounts and premium. Basic level is non-marketable minority value. Above that, it's marketable minority value. Above that, it's a controlling value. And at the top of the ladder comes the controlling strategic value. So remember that what is the level of value you are valuing for, and choose the valuation methodologies accordingly. If the valuation methodologies are different, then do the adjustments of discounts and premium to benchmark the same. There are certain rules of thumb also for different industries. There are different rules of thumb, which we should also look into. So the second part, I'm not taking the regulatory valuation requirement in India. And if we look into the regulatory valuation requirements, then broadly there will be these following requirements, which will be the fresh issue of shares, transfer of shares, asset or business transfer, merger, demerger cases, and insolvency and bankruptcy code. And broadly, I'll stop a minute at this slide, that you have to know that which transaction requires which kind of valuation, because the valuation standards permit departures in order to comply with the legislative, regulatory, and authoritative requirement. What does this mean? That when we say the valuation should be compliant with valuation standards, but if a law has prescribed a valuation methodology, in general, the valuation standards say that we have to value using 3 approaches. We have to apply all approaches and then conclude it. But what if Rule 11 UA is telling us that apply an asset-based approach? What if some other regulation is telling us to apply a particular approach? So if there is a regulatory requirement, we have to follow that regulatory requirement, and that actually overrides the valuation standards. Importantly, it's not that everywhere for all transactions same methodologies can be applied. No. In fact, somewhere there might not be a valuation requirement. I'll give you a small example. Buyback of shares. It's a tricky question. Whether you require a valuation for buyback. If you ask if you require valuation, the answer is yes. But whether it is required under a particular regulatory provision, answer is no. So company law is telling us that you have to disclose the basis of price, but company law is not telling us that that basis of price has to be signed by a valuer. You require a soft valuation, but who is required to sign that valuation? Not prescribed in the regulation. I can give you n number of examples. IPO valuation not required statutorily, but there are certain areas wherein there is a specific prescription of who can do valuation, what are the valuation methodologies, and where in all cases you have to value. And this is an evolving thing. But as on date, for fresh issue of shares, RBI law, income tax, company law, and SEBI requires a valuation certificate. For transfer of shares, there is no requirement of valuation under company law. Please see. RBI and income tax still requires. Even for SEBI, If there is a takeover code which is getting triggered, then that is required. For business combination, company law, SEBI law, financial reporting, right? All these valuations are required. And ESOPs, for financial reporting, there is an independent valuation requirement. And for IBC, there is a valuation requirement. So please remember that a valuation, whether we should take valuation in all cases, the answer is yes. Whether valuation is required in all cases under law, answer is no. In some cases, it is there. In some cases, it is not there. So in the subsequent slides, what we are going to take care of is that under each of these regulations, fresh issue of shares, income tax, fresh issue of shares, Companies Act, fresh issue of shares, FEMA, transfer of shares, IBC, who are required to value, are there any valuation methodologies which are prescribed, and things like that. But before that, let us just break the and let's have some questions. Yeah, Indrajit.
Yes, sir. So we have one question. As per Ind AS and valuation rule, how to value stock in trade in information technology sector?
So, see, it's a debatable question that who has to value stock in trade. And even recent disciplinary cases also cover this. See, the point here is that as an SFA valuer, we are not the technical valuers, right? We are business valuers. So first of all, note here, the asset class is stock in trade in information technology. What could that asset class be? Maybe softwares, laptops, printers, UPS, right? So these kind of assets can be valued using a cost indexation method also. That what was the cost? Because actually, if you look into that, the prices of these assets have not increased. A laptop which used to cost 50,000 today is not worth 1 lakh. The technology has evolved, no? So, the cost is not very much different. So, in my view is that for software assets, a cost indexation method is one. Second could be a comparable benchmarking method wherein some quotations can be asked for. So, if suppose we bought for 5 computers of a particular brand, particular specification, you ask for the similar quotation today, and that will be a replacement cost new. And out of that replacement cost, my existing computer is say 3-year-old. So you will apply that depreciation. And basically, we called it a DRC method, depreciated replacement cost method, which can be applied. But the question is important, that whether a SFA valuer is supposed to value financial inventory. That's a debatable question. In my view, assets, these kind of assets can still be valued, but not the, for example, if there's a power plant, there's a hotel, SFA valuer cannot value technical assets, basically. Yeah.
Thank you, sir. I hope the questioner get the answer. Next question is, what are the supporting documents or reference generally available for considering the fair value?
Supporting documents for fair value.
Yes, for considering the fair value.
No, so what is the asset? It is important. What are you trying to value? Are you valuing investment, or what is the asset to be valued? So I think the question is incomplete.
Okay. So moving towards next question, for e-commerce, how valuation is done when CAC, customer acquisition cost, paid to Facebook, Google, etc. platform in initial years is high, thereby resulting in huge operating loss?
See, so let us look at it like a startup company. And essentially, you have to value them based on the futuristic cash flows, because right now there could be only 2 methodologies for valuing a loss-making companies. Either you do a discounted cash flows based on future, or you do a price to sales multiple. So these are the only two methods. The question is again, come back to the basics, that if the CAC, cost of acquisition, is permanently significantly high, then whether the business can actually be monetized. I'll give you one example. And there are large fintech companies operating in UPI, but the challenge is that UPI is not generating revenues. So even though you have acquired a number of users, you are earning through them if they are doing transactions. But UPI per se, there is no charge on UPI, right? I can transfer any funds to you using bank to bank free of cost. So, I mean, the challenge is very important, that whether these kind of models can have futuristic vision. And let me also tell you one thing. See what happens now, we are in a digital domain. Everything is online. Whatever we are speaking, it's getting recorded, right? Similarly, a number of valuations which have happened in the past. I was recently reading some research report wherein, you know, some of the journalists, what that journalist did, that, you know, download all the old reports from the MCA portal, that these are the 10 reports and there are projections of a company. Now, what was projected 5 years back, you compare that to today and you say nothing has happened. So that is, you know, that is how a startup is, that when you do a discounted cash flow or projection, how much you know, sometimes a DCF is just done to arrive at a number, but whether that's the right strategy. So, you know, the assumptions can get tested, the assumptions can get questioned, and that is why valuation is at a point of time, known or knowable on the valuation date. I mean, I projected something of a company and after that the license got cancelled. It's not my responsibility, no, at that point of time. So all the business trends, all the assumptions needs to be tested on the valuation date, and basis that a sustainable cash flow model needs to be prepared. And particularly for these kind of companies, I would say that also take some time in review of their financial models. Sometimes their financial models are not prepared properly. So it is very important that once you sanitize the model, we also call DCF as garbage in, garbage out. You know, that, I mean, it's a funnel, whatever you put here, ultimately that has to come. So if the model is not sanitized, the valuation cannot be.
Thank you so much, sir. Yes, sir. So next question is, will you share the best case law where Supreme Court has given remarkable judgment? I think it is another incomplete question, because regarding what they want.
Yeah, maybe so. On valuation, there are few judgments, like Mafatlal and Mafatlal is one old judgment which is there. Then Hindustan Liver judgment is there. So basically, these judgments have said that if a valuer has a professional valuer has done its job, so merely because you can have a different view and I can have a different view does not mean that my valuation is good or bad. If I have justified my work that I have performed and I have explained it, then I stand safe. And the only thing is that, see, these are matters of professional opinion, and each professional will have varied experience. So I think to that extent, it's not that, one can get questioned and another cannot get questioned. Yeah.
Okay, moving towards next question. Issuance
How many
of
questions we have? Just let me know.
To another question.
Okay.
Or I can take it in at last.
Yeah, let me just proceed. Yeah.
Okay.
We'll
Thanks.
take it up. So coming to the fresh issue of shares, if we look into fresh issue of share, this is a typical structure that fresh issuance takes place. Now here it is important that each law has its own independent view and judgments. So let's look into the company law first. Now in company law, first of all, company law is covering what? Equity shares, convertible shares, optionally convertible, fully convertible. Company law is covering all convertible instruments and equity shares, right? So very important to know that what all instruments are covered, what is the pricing methodology, and who is the valuer. These three things are consistent in the presentation, and I can share the presentation, no issues in that. That applicability is the issue of shares and convertible instruments, valuation to be done only by a merchant banker, valuation to be done only by a registered valuer, and in case of the preferential allotment for listed companies, you have to follow the SEBI regulations. So for SEBI regulations, follow what SEBI regulations say, which we will take separately. For otherwise, so no method is prescribed, follow the regulations which are there, registered valuer and valuation rules, which we have just seen, and basis that we have to do. Coming to the income tax, and there are no valuation for transfer of share under company law. I just mentioned that. Come to the income tax. Now, like company law says that it has to be shares and convertible instruments. Income tax has a slight difference, that income tax segregates between equity shares and other than equity shares. So what does that mean is that if there is any instrument other than shares, for example, there is a debenture, then that is out of purview of income tax. Very important and fine aspect that I'm telling you, that equity share and other than equity share, there are different methodologies. But if there is an instrument which is other than equity share or other than share, then there is no valuation requirement under income tax. Second, income tax has two methodologies and two bases. One income tax says that there is a minimum valuation, another income tax says that there is a maximum valuation. The maximum valuation is in case of issue of shares, and these are the sections which are mentioned there. The section reads that I have not put in the text of the section, it will get too complicated, but I'm just telling you that what does the income tax provision says, that if the issue of shares of an unlisted company takes place at a premium and the methodology uses discounted cash flow method, then it has to be valued only by a merchant banker. So if there is an issue of shares of an unlisted company which is taking place at a premium, so that means that if you issue the shares at face value, there is no requirement of a valuation. So first thing I have mentioned, that if you do a valuation for any instrument other than shares, there is no valuation. Second, I have mentioned that if the transaction takes place not at a premium, if it takes place at a face value, there is no valuation for income tax. And if there's a DCF method for a premium, then only a merchant banker can do a valuation. So these three things are important. What about other than equity shares? Other than equity shares, there is no methodology if you look into here. So for equity share, the methodology is actually DCF or NAV. If you apply DCF, you also require a merchant banker. If you apply NAV, you do not require a merchant banker. Correct? So there is a general view which is there that a valuation, all valuations of income tax require merchant banker. That's not correct in my view. You require merchant banker only when a DCF method is prescribed and for issue of shares at a premium. For other cases, for valuation of shares other than equity shares, the methodology is price it would fetch in the open market, which again comes down to the general valuation principles. And again, in these cases, when there are shares other than equity shares, then again, who can value? That anybody can value in that case. Let's come to transfer of shares. And this is the maximum value, by the way. So there is a maximum value which is prescribed under the tax laws, which has to be, so DCF is a maximum ceiling here, correct? What about transfer of shares? So if you transfer of shares, the section is 56 to 10. In case of issue, it was 56 to 7B. So transfer of shares, the methodology is adjusted book value method. What does this mean? That you take the balance sheet. An important aspect here is that the balance sheet which is required in this law, in this case, needs to be audited on the balance sheet date, on the transaction date. So if the transaction, say today is 23rd of April 23, and today you want to transfer some shares, the law says you prepare the audited balance sheet of today, which is practically unreasonable. So there could be two perspectives and two practical solutions to that. You take a provisional balance sheet as on date and do a valuation. Second, you take a closest audited balance sheet, which could be, let's say, 31st of March. What if we go back? Can we take 31st of March 22? Answer is no. Because this law is very simple. It is giving a minimum price. So for minimum price, it wants to prepare a latest balance sheet, and that to an audited balance sheet on the date of the transaction. The methodology is adjusted book value method. Few adjustments needs to be done, which we will just cover in the subsequent slides. And again, who can do valuation is not required. So can a registered valuer do valuation? Why not? Registered valuer can also do, because it is not prohibited. Chartered accountant can also do, and a merchant banker can also do. There is a inclination towards merchant banker, because in one of the provisions, the tax regulator has mentioned about merchant banker, but that is what it is. Valuation for slump sale. If you transfer the business as a whole, how do you do valuation? So this regulation says that, again, the same regulation, 11 UA regulation, valuation for transfer of shares, which we just discussed, the same methodology is prescribed. And now I am telling you that what exactly is the methodology. So you have to take the book value of assets other than the few assets. And the few assets which are excluded are: one, the jewelry and artistic works, which we generally don't find in most of the companies. Second, the shares and securities, which we find in a lot of companies. And the law is fair value of the shares and securities. So we are valuing company A. Company A has invested in company B. How do we value company A? So for valuing company A, we also need the valuation of company B, and company B also needs to be valued in the same format and same methodology. So what does this mean? That if company B has also made investment in company C, then company C also needs to be valued, and then D and E and F. So if there are companies where there are circular investments, there are cross investments, for the purpose of computing the minimum value of shares, each of these companies needs to be separately valued. And that is very, very important to know, because it could be complicated. We have done cases wherein there were like 57 companies, each under each, and then with cross holdings. So each and every company needs to be valued. And it's not that the investments can be taken at book value. Investments have to be fair valued. Similarly, if there are immovable properties in the main subject company or in the downstream investments, any level, each of the investments, each of the fixed assets of these companies needs to be fair valued. And the minimum value for these tangible assets, which is only immovable property we are talking. We are not talking of plant and machinery. We are only talking of land and building. So number one, all the investment needs to be fair valued. Number two, the land and building need to be fair valued. And the minimum price is the circle rate. So whatever is the circle rate of that area, we have to take that circle rate. And sometimes, if the properties are old, value difference could be significant. So valuation for slump sale, just to clarify, and valuation for transfer of shares, the methodology is same. 56-10 or 50 CA, or all these sections take us to Rule 11 UA, and we also call it Rule 11 UA valuation, which is a minimum valuation with fair adjustments of investments and fair investments of land and building. What to do in case of indirect transfer of shares? So, when we say indirect transfer of shares, it says that there is an investment which is involved from a foreign company. So instead of transferring the Indian company, a foreign company is being transferred. And when the foreign company is being transferred, then the Indian business is automatically getting transferred. It is also, if you would have known of the Vodafone law, I mean, the Vodafone judgment was entirely on this basis, And then there are certain criteria in which case the valuation is to be required. These are complex valuations. Again, there are methodologies prescribed, but here the merchant banker or a chartered accountant has to do valuation. In this particular scenario, it's not that any chartered accountant can do. There is a particular definition of chartered accountant that if you have a professional receipts of a particular number, and then only you are authorized to do in this valuation, because these are a little complex valuations. Some other cases wherein, like for example, transfer pricing. If transfer pricing is involved and there is a valuation requirement, maybe a company is transferring its business to a group company, and these are say MNCs. All these valuations, even though the slump sale mechanism provides a minimum value, but because there are transfer pricing mechanisms getting triggered, and all the transfer pricing mechanism needs to be done at an arm's length price. So it's not that if you are doing a slump sale, you can do at any price. If there is an application of transfer pricing, then in that case, the valuation requirement is actually at an arm's length price, which needs to be done. Coming to the Reserve Bank of India. So we have discussed the company law, we have discussed the tax law. Coming to the third regulator, the RBI. And RBI again, so important thing for just as a recap, for Companies Act, for fresh issue of shares, there is valuation. Transfer of shares, there is no valuation. For income tax, fresh issue of shares, there is a different valuation. Transfer of shares, there is a different valuation. For RBI, whether transfer of shares or fresh issue of shares, in both the cases, there is valuation, and the valuation is same in this case. Here, again, as on date, when it comes to RBI, what all are the instruments that are required to be valued? So the instruments for RBI are equity share and fully convertible instruments. So if there is an optionally convertible instrument, that does not require valuation, because an optionally convertible instrument falls under the definition of ECB, and ECB is in debt. ECB is not an equity. So for Companies Act, it was equity shares and it was convertible shares. For income tax, it was equity shares and other than equity shares. For RBI, it is equity shares and fully convertible instruments. So each law has created its own set of instruments, its own pricing guidelines. And here it is again, the valuation needs to be done based on the internationally accepted pricing methodologies. Wherever there are listed companies involved, the onus or the authority has been given to SEBI to decide what kind of methodologies they want, because for listed companies, there is greater public interest involved. And here again, a chartered accountant can do a valuation, cost accountant can do a valuation, and a merchant banker can do a valuation. As on now, a registered valuer cannot do a valuation under the RBI FDI guidelines. And in case of swap of shares, wherein the consideration is involved is not in cash, but the consideration is shares, then in that case, a merchant banker has to do valuation. An important learning here is that recently SEBI has suggested, the RBI has suggested that the valuation should not be more than 90 days old on the date of the transaction. So when we file with the authorized dealer an FCGPR form that this is the transaction which is taking place, the valuation should not be more than 90 days old. So I mean, the idea is that each regulator has prescribed different regulations, and we are also converging. What happens in case of an ODI regulations? So when we say ODI, it means that my Indian company is investing in a foreign company. When it means an FDI, that means that an Indian company is receiving the funds, right? Or maybe Indian companies' shares are required to be valued. Here in ODI, the foreign company shares are required to be valued. So as per the latest guidelines, it has to be again done by the internationally accepted pricing guidelines and at arm's length price. And one particular provision wherein in ODI regulations, IBBI registered valuer name has come is that if there is restructuring of foreign company is taking place, then their IBBI registered valuer can do that. Coming to the SEBI regulations, As per SEBI regulations, SEBI ICDR regulations has a preferential issue guidelines. So preferential issue is when a similar case wherein, let's say, fresh issue of shares. Now they have segregated, the SEBI has further segregated shares into frequently traded and infrequently traded. There is no concept of frequently and infrequently under income tax, under RBI. But there is a requirement even for, even if you have to value a listed company, then income tax does not ask you to refer to SEBI guidelines. Interesting that Companies Act is saying, RBI is saying move to the SEBI guidelines, but the tax laws are not saying. So in income tax, the market price is market price, whether frequent or infrequent. But in case of SEBI particularly, and in general, rightfully so, that shares should be segregated into shares which are actively traded and shares which are infrequently traded. And there is a definition of what is an infrequently traded share. Generally, it's a 10% trading volume. If there's a 10% trading volume in an year, then it's a frequent share, otherwise it's an infrequent share. And all these valuations are to be done by a registered valuer. Important thing here is that in case of frequently traded share, do you need a certification? Because if you look into an infrequent traded share, you definitely need a valuation. You need a valuation basis the book value, basis the comparable pricing multiples of the similar companies. But what about a company which is frequently traded? There is a pricing mechanism which is based on the particular day's volume weighted average price. To be particular, it's the higher of 90 and 10 trading days VWAP. And why it is VWAP? Because sometimes, one share has traded at a price and then 10,000 shares have traded at a price. So if you do a simple pricing, then both the shares will count. 10,000 shares price will also count one share. So there is a probability of manipulation. So if you look into the pricing, then the price is different and VWAP, volume weighted average price, is different. VWAP is given by the stock exchanges, and VWAP is considered as a better version of price discovery, because the maximum number of shares are actually, so the number of, it's not the plain vanilla price, it's the price which is linked with the number of shares also. And that is how this valuation is done. Important thing, like we discussed, that for infrequently traded shares, the discovery is based on book value, comparable traded multiples. So CCM method, like we just discussed, book value method, like we just discussed, and a registered valuer has to do valuation for SEBI, not merchant banker. A registered valuer has to do valuation. Important and latest regulation is 166A. What this 166A tells us, that if there is change in more than 5% of the share capital on fully dilutive basis. So if there is a listed company, the shares are frequently traded, but the preferential allotment leads in change in 5%, more than 5% of the shares, you require a mandatory registered valuer valuation. So does that needs to be on the basis of the 90 and 10 trading days? No. 90 and 10 trading days you have to do. That comes under regulation 164. But you have to do an independent valuation. So generally that is done again using the comparable companies trading multiple. My company is getting a 5-time PE. Group, the other companies are getting a 10 times PE. So maybe my price should also be higher. The idea is that the regulators want, again, the minimum price, like the company law is giving minimum price, SEBI law is also giving minimum price. If you bring money above that price, SEBI has no issue. But if you bring price lower than that, then there is an issue. And there is another requirement here. So you do a market price discovery, you do a registered value or independent valuation for more than 5%. And if your article of association has some particular clause, you also have to take care. And this article of association came through that PNB housing issue, which came recently, that if there's a particular pricing mechanism in your articles, you should follow that. And again, whichever is the highest, you take that. What in case there is a preferential allotment leading to a change of control. A registered valuer has to determine that what should be the control premium. Very, very important. Very, very important. And see the perspective of SEBI, that SEBI regulations are actually so much evolving and they are putting emphasis on valuations. The idea is to control the minority shareholders. The idea is to bring in best practices. And how do you determine a control premium? It's a debate in itself. So you have to go back, you have to see that how much is the control premium which has been given in the past for similar transactions. A lot of studies are required, but the take home is that if there is a change of control, then there is a requirement of determination of a control premium. Again, for transfer of shares, there are SEBI takeover regulations, and under takeover regulations, there is a again volume weighted average market price. Here, the requirement is of 60 trading days. If the shares are infrequently traded, the pricing is same. And here, in case of transfer of shares, takeover regulations, right now the requirement is of independent chartered accountant having a minimum experience of 10 years. Maybe this can also shortly this would also get changed, but as of now, this is the rule. Now, coming to merger regulations, like I just mentioned, that SEBI is quite proactive in prescribing the valuation methodologies. And you look into that, SEBI has already prescribed the format that there are 3 methodologies. You apply all 3 methodologies, or you don't apply, you have to give reasons. You have to explain that why you are applying a particular method and why you are not applying a particular method. And important price here is that the price, the market price, if it's a listed company, then the market price needs to be determined as per the SEBI preferential allotment guidelines. And just to know that the preferential allotment guideline price needs to be taken till the date of board meeting in which the scheme is being approved. So if there is a merger of one company into another company, then the relevant date here is the scheme in which the board meeting in which the scheme is being approved. And one day prior to that particular day, you have to take the price and determine that. And also when you are valuing unlisted companies, then unlisted companies or financials also need to be audited and also need not be more than 3 months old. So there are a lot of regulations, a lot of requirements are there. In addition to doing valuation by a registered valuer, scheme of arrangements do require a fairness opinion from a merchant banker. And after the acquisition is done, then the company, because now it is Ind AS requires all the assets to be fair valued. So there needs to be a purchase price allocation of the intangibles. And this is an example of purchase price allocation, wherein we need to first identify that what all are the intangibles. It could be a brand, it could be a customer contract, it could be some patent or something which needs to be done. And the last, before we start having question answer, and please send whatever questions you require, there's the valuation for IBC. And IBC is the landmark change in valuation. In fact, the IBC has taken the valuation ecosystem to the next level. A lot of debates have started happening. What should be the methodology? Who should do the method? Who should do the valuation? Read the IBBI orders. A lot of thought-provoking questions are there, that whether we are doing the valuation in a complete manner, whether the data is available, because sometimes there are limitations. How should we send through this Manthan series? I think a lot of questions will get answered. So IBC has 2 regulations. One is the CIRP regulations, which is corporate insolvency and regulation proceedings. And basically there is a requirement of 2 registered valuers. The requirement is to do a fair value and liquidation value of the assets of the corporate debtor after doing a site visit and in accordance with internationally acceptable valuation standards. So there have been a recent order, and wherein a firm registered valuer entity did not perform site visit and the license has been suspended. So please make sure that site visit is very, very important, and everything which is written actually under the regulation, We can debate how relevant is that, how much impact. But when we deal with the regulator, I think the idea is not to debate, the idea is to follow. So follow the minimum requirements and it makes our life easy. Again, there is a second valuation, which is CLP proceedings. So CIRP happens at an initial level wherein a valuer is appointed and a resolution plan is being made. But in case a resolution plan is not successful, if there is no resolution plan, then in that case, the company is liquidated. And then again, a valuation is required for the liquidation value under the IBC. So I think with this, I am completing my session. I've spoken so much, and I'm sure that I would have given some perspective, some insights. And as you look into this slide, then this is how typically a valuation is, that you look at how you want to look at it, and the perspectives changes. So that is why it's important to uh, learn and do peer learning. And I think let us take a few questions and see that what more is required. Yeah, thank you.
Thank you, sir. So we will take another questions. First one is issuance of further shares by private limited company. Does it require valuation?
Yeah, we just discussed, no? So fresh issue of shares require valuation under Companies Act. If the issuance is taking place to a foreign company, it requires under RBI. If the issuance, if it's a listed company, it requires valuation under SEBI. And if the shares are issued at a premium, it also requires valuation under the tax laws. And a slight change in the tax laws, I want to just highlight that earlier, in case of income tax, when the issue of shares used to take place, the valuation used to be covering only the basically the residents. But now, even if the issuance is taking place to a non-resident, the tax valuation is getting triggered. So yes, definitely it is required.
Next question, whether peer review is mandatory for valuation report?
So peer review, the RVO with whom you are registered, the RVO can definitely ask for a few of the valuations which have been performed, and then those can be submitted. A peer review body is there, but the focus right now is on valuations of, the first preference is IBC and second preference is Companies Act. So these two valuations are actually, I would say, deeply screened, and the other valuations as of now, because the idea is that where the public interest is being involved. So SEBI has a different practice, but as of now, the peer review is there, but it is through your RView. Or if there is a complaint, maybe then there could be an inspection or inquiry.
Next question we have, during valuation of going concern, when a control transaction, meaning 100% stake sale is involved, how does one value the intangibles like brands, licenses, product registrations, etc.?
So you have to understand that intangible valuation is not performed separately. Intangible valuation is a subset of business valuation. So you have to, when the idea is to sell the company, see, first of all, you have to see that you can make anything rosy. But when it comes to selling, what is important is where do you stand today? What is your trailing 12 months financials? What is your last audited financials? And what is your latest month-on-month numbers, which is also seen if you are a growing company. So the methodologies don't change. It is just that you have to, so when you get a multiple, let us say you get a 10x multiple of your EBITDA. So that 10x multiple includes the valuation of intangibles also. So intangibles are not supposed to be valued separately. You do a business valuation. And when you do purchase price allocation, then in purchase price allocation, you dissect that how much of this value I have given for the tangible assets and how much I have given for the intangible assets. So you apply a discounted cash flow model, you apply a multiple model, and those models include the intangibles. And so while benchmarking your company, you have to select those companies which have the similar level of or same nature of intangibles. So if you are a pharma company and you value yourself benchmarking with a pharma company, and that pharma company is, let's say, traded on the stock exchanges, then its value includes the value of intangible assets, right?
Next question, in DCF method, should the contingent liability be adjusted?
Yes, you can adjust for the contingent liability, why not? But the question is that how would you adjust for the contingent liability? Because I mean, whether you will say that, I mean, if there is an order which has come, then that's a certain liability. Now, sometimes the companies appeal for it. So whatever you do, you adjust or you don't adjust, but please disclose that in this valuation report, this is the treatment which has been done. Because sometimes it is very difficult. I mean, whether if there is a legal and these are, debatable points. But the idea is that one, there should be a disclosure, because sometimes the contingent liabilities could be too significant. So you should mention that you have not considered it, and then at least it's a fair disclosure.
Okay.
If you can estimate, if there is a legal opinion, you are confident, then you can do that.
Next question, while considering the depreciation for calculating the fair value, should income tax base to be taken or Companies Act?
Income tax. See, understand that what is the rule of depreciation in DCF. Depreciation is a non-cash item, so it needs to be added, right? Depreciation has no relevance at all. Only thing is that depreciation gets the tax benefit. So we have to just take the tax impact. So if you take the company law depreciation, then you will not get depreciation. You will not get tax on company law, right? When the computation will be prepared, the Companies Act will be added and income tax will be reduced. That is how we do, right? So it should be income tax on.
So I'm just taking the last question.
Yeah.
How to do valuation of cross holding investments? Like A holds in B and B holds in A. So how to value A?
Good question. So basically what happens that don't do it manually, first of all, because if you do it manually, I mean, if both companies hold in each other, you need some base. Otherwise, it will give a circular reference. That's the problem, right? So the solution lies in using Excel only. So when you use Excel, then basically there is an iteration formula. Just keep that iteration formula on, increase that to go in settings, and in iteration just keep that to like 999999 and link each other company. So where the company A has to be valued, then do calculations and link company A value with the concluding company B value, and company B value with the concluding company A value. Switch on the iteration formula in Excel, it will give you the answers.
So it was a last question. So I would like to thank you, sir, for sharing your knowledge and expertise with us today and taking all the questions. And your insights have been invaluable, and we appreciate your dedication to the field. And I would like to give my gratitude to each and every one of you for your gracious presence and invaluable contribution to the discourse. So very good day to all of you. And thank you once again, sir, and Valuation Standard Board for organizing such a brilliant webinar today.
Thank you so much. And what I'm doing that I'm just sending here, just a second. I'm just sending my details here. Yeah, so if anybody wants to discuss with me, they can just do so. So thank you so much.
Thank you, sir. Thank you, everyone.
Take care. Bye.